Hi, this is Morgan Smith, financial advisor and partner with WorthPoint, and welcome to our fourth video in the top 10 investing myths or series that we're doing. I'm with special guest Apollo Lupesco, Vice President, Dimensional Fund Advisors. How you doing today, Apollo?
Good to see you. I'm doing well. How are you?
Very good. So let's go ahead and dive in to myth number 4. Active stock picking gives the best results. So let's talk a little bit about what active stock picking is. How can we refer to it versus sometimes you call it, say, passive or index investing. So active stock picking means somebody's out there utilizing whatever means they have at their disposal, whether it's tea leaves, doing bottom up analysis of companies or sectors, looking at macroeconomic analysis, uh, talking to neighbors, and or somebody who quote knows the specific industry. um, what they're trying to do is they're trying to pick those companies or stocks that they think are going to perform the best in most cases. So what I like to tell, and so what I before I get into that, this myth that active stock picking gives the best results, Apollo is going to talk to us today about whether or not that's in fact the case. So thanks again, Apollo. Hopefully, uh, we'll be able to change some minds. We shall
Yeah.
see about this. But one thing I talk to clients about is like, what do we know intuitively? Nobody can predict the future. I don't know anybody that can predict the future. But for whatever reason, despite that fact, people are psychologically kind of wired to think that they've got some special skill and they can predict the future, or there's somebody out there with some special insight or knowledge that can predict the future as well. And I think sometimes it looks like people do have special skills. And then you start talking about, well, was it luck or was it skill? So I'll pause there and let you dive into this, Apollo.
Yeah, no, and for sure, because it is intuitively appealing. Like, listen, why not just focus on the companies that really have the biggest promise that they can make the most money? Why have all the other loser stocks when we can just focus on the good ones? And I think that's kind of the idea, which is again, it's intuitively appealing. And what's interesting is that really, if you were to look at the entire stock market, and let's just consider this particular square to represent all the stocks that would be in the market. Stock picking reflects the idea that somebody would cherry pick a handful of these stocks and leave out everything else. So you start with nothing and you find reasons to maybe hold a few stocks. And if you get the right ones, then you're actually going to make a lot of money. So to me, when you look at this, the alternative to this would be something that's a little bit broader in nature. And instead of focusing on all these stocks, perhaps you can say, yes, we're going to hold these stocks. And at the same time, we're going to be diversified across markets and buy other stocks around it, knowing that some of them are going to go up and some are going to go down, but lacking that precision that Morgan talked about. Why not just buy a lot more? So the first reason that I think stock picking is something that I would not encourage people is the first reason is because the more you can either make a lot of money, and certainly you can do that. You can make a killing, but also at the same time, the more you concentrate, the more you can lose a lot of money. So you can really be down quite a bit. And in an extreme case, you can lose everything if you're very concentrated into a stock or some other investment position. So to me, the concentration is important because as an investor, I'm not sure how many people need to either make a killing or get killed. I think it's wiser for people to try to reduce the range of outcomes. And instead of focusing on this, just a handful of pick stocks, you can avoid the extremes by really diversifying well beyond just these stocks. So the first reason that I think you got to be careful with stock picking is that stock picking makes sense if you concentrate. But the more you concentrate, you can either make a lot of money or lose a lot of money. You can try to avoid these extreme outcomes if you diversify. It doesn't mean you're not going to lose money. It's just not going to be as extreme. So that's the first reason that I think it's not really the best strategy. But the fundamental reason that I think this is a myth is because in order for somebody to successfully pick these stocks, it's all about information. And years ago, Benjamin Graham, who was Warren Buffett's mentor, suggested that as an investor, you auto analyze a lot of the things that Morgan talked about. Analyze companies, really try to figure out what's the future, what are their financials saying. All this information would help you get a competitive advantage in the market. And in the stock market, it's all about data, information, and competitive advantage. And he suggested if you analyze the numbers, if you get better data, if you can process it in a superior way, that ought to give you that competitive edge in the market so you can pick the right stocks. And who can argue? Look, Benjamin Graham is Warren Buffett's mentor. Warren Buffett has credited him with these ideas, and he certainly is known as a well known investor, very successful. Why is it that it's a myth then? The reason it's a myth is because there was a time when an investor can get better information, or he can get it faster, or he can process it in a superior way. And all of these things gave somebody a competitive edge in the market. Today, information travels incredibly fast. And the level of information is incredible that somebody can get a hold of. And number three, today it is not competitive, it's hyper competitive. There are more professionally managed funds than actual stocks trading on the market. It's incredibly competitive. And because of that, it's hard to believe that somebody can consistently outsmart everybody else. So what does it actually mean to you? What it means to you that if you try to analyze individual stocks and think that you can get a competitive advantage, it's quite possible that by the time you put in the fees, you might not be able to do it as well as one might think. And if you look at the data and we analyze funds that are doing this, what we found is that out of the 3,000 funds or so they were analyzed over 10 years, about 30% or so, 32% of them actually disappeared. They just got closed. So if you invest in those, they didn't even survive for 10 years. And out of the survivors, only about 27% actually outperformed, meaning that 73% of the funds over 10 years underperformed, which is incredible because in that case, you have, out of four funds that are put in front of you, three out of those fours roughly are going to underperform. So your odds are much greater that you're going to pick an underperforming fund than the outperforming one. And those change, the winners change all the time. It's not consistent. If you go to 15 years, you give them more time, even fewer survive and even fewer win, stay ahead of the market, outperform. And over 20 years, even fewer, roughly about 1 in 6 over 20 years actually outperform, 5 in 6 underperform. So to me, it really goes back to this notion that is it a myth? It might have made sense maybe 20, 30 years ago when somebody perhaps can get quicker information or better information or had an edge in the way they process it. Today, in the world that we live today, it is no longer the case. I think that it's way too competitive to say that somebody can consistently outsmart, and that's exactly what the data suggests. That trying to pick individual stocks is no longer what it used to be, and you have a much better chance of just being more broadly diversified in a market portfolio than trying to select these managers.
That's very interesting data. And what I talk to clients about and other folks is like a speculation. We're not trying to say it's evil. And guess what? Anybody who's a business owner speculating on that business that they own and they're running. Maybe you buy a piece of real estate or go buy a stock. And entrepreneurs, the backbone of our country, they're speculating. When I talk about diversification with clients and folks that I'm talking to about investing, I go, okay, look at when we talk about this diversification and not speculating, really think about it in the context of money that you cannot afford to lose.
Right.
So if you want to take a percentage of your assets and put that at risk, or you did that early in your life and you started a business and created a whole bunch of wealth, good on you. I wonder what the percentage of successful business owners versus non-successful business owners is. But speculate away, but realize that if you've got money you can't afford to lose, maybe diversification is a better way to look at things. And that's why we're talking about this difference between speculating and active stock picking versus kind of diversified portfolios.
Absolutely, and in fact, to follow up on that, Morgan, I also believe there's a fundamental difference between somebody starting a business, and that is the fact that you can bring your own competitive advantage and make it part of the business. So, in other words, if you are the Steve Jobs of air conditioning, and you have that knack for air conditioning, well, that's a competitive advantage, and you contribute to the success of the business because you can bring that competitive advantage to bear fruit and make you money. If you participate in the stock market, it's different because these are publicly traded stocks that everybody has access to information, everybody knows about, and it's a very different dynamic. So if you want to build a business, I would actually say, to your point, it's the backbone of our country, and you are bringing your own competitive advantage, and that's what might make it successful for you because you get involved and you have that competitive advantage. Whereas in the stock market, the playing field is so level that it's not possible to have that competitive advantage that you would in a private business.
Good point. I think we went off on a little interesting tangent with
Yeah.
that, but I think that's a really good point. And I think when you talk about entrepreneurship and businesses, there's some things to think about with regard to cash flows of your businesses and things like that, and as opposed to owning stock. Well, great. That was a great conversation. I really appreciated that, Apollo. Thanks for joining us and giving us perspective on myth number 4 video here. Active stock picking gives the best results. My name is Morgan Smith, advisor and partner with WorthPoint. I can be found at worthpointinvest.com. And join us on our next video, which is the continuation of our series here. Paulo, thanks for joining me. Have a great day, and we'll talk soon.
It's great fun. See you soon.